Welcome to our final webinar of 2020, and it is celebrating 6 years of growth in the BizNews Share portfolio. Compound annual growth rate in rands just under 30% a year. This webinar is only for BizNews Premium members live, although we do have a recording available to the entire community. We do this so that BizNews community members can pose their questions. So please use the opportunity, get those questions in early. I'm Alec Hogg at home, as you can see, for this webinar, and there is my good friend and colleague Stuart Lohman, who's in our new studio. So we've got a new studio now. We work. Eh?
Yeah,
and
very exciting, very light, I think.
I have got a pal, well, I shouldn't say a pal, but he is, who I saw last week in a business meeting, and the poor guy has tested positive for COVID. So as a result, because we were in the same room at the same time, I'm self-isolating. So that's why I'm not in the office today. Stu, is that our office behind you now?
Yes, like you can see the main office with the team. I think it's this side here. On my, I can't work on my left or right. Sorry, looking in reflections. But yeah, just this. And obviously on the other side's the open WeWork studio, building. Sorry. So I sit in the hot seat today, because you're not here.
You're in the hot seat. Well, that's very good. But I have done all my work for the portfolio, and looking forward to. I guess you always do when you've got a good performance. It's always good to be able to share good news, and we certainly have that today. But before we get into it, Stu, do you want to give us some insights into how all the tech works?
Excellent, thanks, Alec. Just quickly on the technical, if you can hear my voice and see Alec myself on the screen with a presentation below, there's a little half five. I see they're coming through, Alec. You see this is the monthly one. Everyone's got that half five on speed dial there. That's great to see. Thanks, everyone. Alec also mentioned in the intro the questions. Please pose them quite early so we can get through them. We do seem to run through this webinar quite quickly. There's a little question mark on that same control panel. If you put your questions in there, I'll pass them on to Alec as we run through. But Alec, all looks in order.
Excellent. Right. Well, let's kick off then. We do have a lot to go through today. And as you can see from the, hang on, I'm going to just get myself off screen. There we go. So we can focus, and Stuart's also gone. So we can focus on exactly what happened in the past month. It's been another really, really strong month, as you can see. The portfolio, remember, we started this portfolio with $200,000 6 years ago this month. It was on the 5th of December 2014, and the portfolio is now worth $653,000. It's just broken above $700,000 for the very first time in the portfolio update today. So in 6 years, from $200,000 to $700,000, my word, what a fantastic performance we've had. Then again, primarily, as you'll see in a while, due to an extraordinary performance from Amazon.com, buying into that in December 2014 was one of the smartest calls I've ever made in my life anyway. But we've also had some very good performances elsewhere. This thing that you can see, this table rather, that you can see on screen now, lets you have an understanding of what happened in the past month. We will be going through the three big winners. They are Slack, which had a takeover offer presented in the past month. It was at under $30 a share a month ago, now at 42.25. Then we have Cloudflare, which was up another 23% in this month after going up to $66 in the previous month. It now is above $80. In fact, it got to almost 85 at one point. And the other big winner for the month was Spotify, and that was on a purchase of a company called Megaphone. I'll go into that some detail there as well, and that's up 19% in the month. On the local front, though, a fantastic month as well for the Discovery share price, up 16%, primarily on the back of the announcement that Hilton Kellner, who's been with the company for 24 years, he's only 45. He joined the company after meeting Adrian Gore and Barry Swartzberg while he was still a student, and then came into the business and has been groomed for big things. Brilliant young man, still at 45, who is now taking over as the CEO of the biggest bet that Discovery has made to date, and that is in Discovery Bank. I had a good interview with Hilton. When I say good, it went on for about 15 or so minutes, but good in the sense that it unpacked a lot of what he anticipates is going to happen at the bank under his watch. And also, he brought us up to date on what was going on at the bank, given that it's gone through its first 5 years of heavy investment, billions of rands that have been put into it. But it really was a tech play to begin with, and they couldn't have anyone better than the guy who actually ran it, Barry Hoare, who those with long memories will remember that he was head of technology under Richard Laubscher at Nedbank when Nedbank was way ahead of the rest of the South African banking market on the tech side. Barry then left shortly after Laubscher departed to join South African Revenue Services and was the man instrumental in driving through one of the most sophisticated revenue services that we have in the world that we have here in South Africa, SARS e-filing. And then Barry went 5 years ago to join Discovery to be the man who actually got the bank to the point that it's at now. And Hilton Kellner, who was formerly head of marketing at Discovery, then became head of Discovery South Africa for the last 2 years. He's now become the man running the bank. So if ever there was the right person that they've put into the hot seat, it will be Hilton. And the share price has reacted up by 16%. Probably 3/4 of that was after the announcement of Hilton Kellner's appointment. So a pretty good month, well, an exceptional month. Can you imagine taking 5% a month indefinitely in Rand terms, and that's after the Rand is appreciated as well. So it's been another very good month for the portfolio, closing off just below 30% compound annual growth rate for that portfolio, which started in December 2014 at 2.2 million rands, and it's now at 10 million rands. So it just shows you, if you manage to achieve those kind of compounded annual growth rates, what actually happens to the nominal value of the investments that you've made. And that also brings us back to this whole story that I keep harping on about, in fact, have been doing so for 6 years, exponentiality. We battle as a species to understand what 30% on 30% on 30% on 30% actually translates into. And as a consequence, for years, we've been undervaluing exponential companies. But if you just sit down and you do that on an Excel spreadsheet, or think about this portfolio, which started at $200,000 6 years later with a growth rate of 23%, remember that's in US dollars, has taken us to $700,000. It gives you an understanding of what the story is with the exponential companies that we do have in our portfolio. I'm just going to take you through some of the big moves of the month, those 3 stocks that I wanted to spend a bit more time on. The first of these is Slack. You can see there on the graph, and I just love this Bloomberg software that we now have with our new contract with Bloomberg. It's called Chartmaker. Thank you, Bloomberg, wherever you are and whoever's been hearing, because it can give us now the ability to show you in a lot more detail exactly what these charts are trying to reflect. You can see that we bought Slack shares over a period of 3 months, concluding the purchases there in June 2020. The share price went the wrong way for a while. Well, it had a little uptick twice, but generally speaking, it was going in the wrong direction. But what made me confident about Slack is two things. First of all, we use it in BizNews, and it is a phenomenal product. And secondly, if you have a look back at where the IPO was, or just after the shares were listed in June 2019, they were over $35 a share. So if you're buying in at under $30 a share, then you are surely, if you know the company and you like the story, then as long as you're prepared to hold on, you will be in a good place. And that's exactly what happened. We then had a takeover offer for Slack from Salesforce. Our other partners, our other global partners, Wall Street Journal, reported this in early November. And a consequence of that was that the share price surged. It was a couple of days after the Wall Street Journal had reported this that the confirmation came through that Salesforce have bid for the company. The question, I guess, for all holders of Slack is, what do you do now? You've made money out of it if you've followed our portfolio and our moves on this. Well, we have decided that we'll sell, and there are a couple of reasons for this. I did the numbers the other day. I actually initially took some figures that I read in one of the articles, which said it was purchased at 25 times sales. That's actually not true. When you look at the actual purchase price, and I did the calculations myself, it's more than 40 times this year's revenues that Slack is going to generate. Sure, Slack is growing at an exponential rate. That's why it's so appealing to Salesforce. Indeed, Salesforce are going to use Slack and the technology that's in Slack at the moment as its driving force into the future. But still, at more than 40 times the most recent year's sales, there's only one company that can afford the $27 billion that Slack is going to cost and will be allowed to do it, and that is Salesforce. Microsoft would love to be able to buy Slack because it's a direct competitor with Teams, the Microsoft Teams, which has had very mixed reports from the many people that I know anyway. And Microsoft, however, would never be allowed to purchase Slack, whereas Salesforce, and the reason Microsoft wouldn't is because of antitrust issues. Salesforce doesn't have that issue. So on the one hand, it's unlikely that anybody else is going to come and have a counter bid for this, because while Slack is worth 44 times sales to Salesforce, it's not worth that much to pretty much anybody else on the planet. So it's only a couple of dollars difference from where we are at the moment in the share price to what the offer price is, and that would suggest that it's all in the price now. So we have decided to sell our Slack shareholding and to put the money into the bank for the moment. But a very, very nice month due to a 41% increase in that share price. Cloudflare, look at this baby. We bought into Cloudflare, as you can see, around $20 a share, right at the bottom of the market for the very first time we could, after the COVID panic was sending everybody into tailspin and sending share prices into tailspin. The reason I was so keen on Cloudflare was, if you can have a look back a little bit, it's always been an expensive stock, trading at a multiple of its sales. It's been a stock that is that you'd be looking for the dips. ASML, the one that David Shapiro likes so much, is another one of those kind of shares. Here in South Africa, for instance, a company like Purple Capital that's moving is a very disruptive player at the bottom end of the stockbroking market, our equivalent, I guess, of Robin Hood, those the players in the United States. That would be another one to look at when you see the share price comes back a bit. And Cloudflare was definitely one I've been watching for a long time. Again, we use the product, and it is a brilliant product at very, very low cost. And it's in an area that is expanding, multiplying dramatically in size. And they're the market leader, global market leader. So Cloudflare was always one that I would have loved to have added to the portfolio. But a bit like Spotify and Netflix, it was just too expensive until the wipeout that came through the COVID panic. You can see where BizNews made, or the portfolio made, its purchase. The results, then after the panic settled down, the share price of Cloudflare started going up because, as we understood, there was a move towards sending people home. There was also much more of a move towards online. That made a online security company, which is what Cloudflare does, more valuable. And so the share price pretty much doubled from where it started off in the worst of the pandemic. Then the second quarter results were released. You can see there wasn't a heck of a lot of change to that. I guess most of that was in the price. And then the announcement of Cloudflare One, which is a highly innovative and very disruptive technology that enables the security of people who are at home. So when you go into the premises of an office, there's usually well, there used to be a mainframe computer, but now there's a security system so that when you plug in your laptop or you're working off a desktop, that's all very well protected. But what happens when people take those laptops home? And that was the big concern that many corporates had. Well, Cloudflare One addresses exactly that market. So you can go home and be just as secure working on your device as you would be sitting in the office. Clearly, it's very important given that many more people are now working from home because of COVID. And the announcement of that breakthrough technology gave the share price another push. And now we have the third quarter results that have just been released, and that's given it yet another push. So we're up 23% in the past month after similar increases in the last two. It's been a phenomenal stock to be invested in, and another value, or another way of showing that if you go just below the big ones and you go and find these highly innovative technology shares that are growing exponentially, this one is growing at 50% a year, then you can start extrapolating it and have a good ride into the future. I've got a couple that I'll talk about later that we are looking at as purchases, but haven't actually done anything yet. I haven't finished my homework on it. But Cloudflare, very happy to have that one in the portfolio. And then the third of the big winners of the past month was Spotify. You can see here, again, we bought pretty much at the bottom of the market, down, well, below 100, well below $150. The share price is now well over $300 a share. And after the third quarter results came out of Spotify, even though the numbers grew, it now has 320 million people who are using the service. The growth rate there is well over 20%, and that's what you identify or can classify as exponential. And then came the acquisition of Megaphone. Why this is transforming Spotify's future is, if you recall, when we first bought Spotify, and I'd liked Spotify for a long time, it became relatively cheap. It's never going to be cheap, but relatively cheap after the pandemic panic. The reason we bought it was because Spotify is moving very aggressively into podcasts. Where we sit at BizNews, we know quite a lot about podcasts. We've been putting a lot of our energy and effort into podcasts, and Spotify is making a concerted effort to dominate this market. Megaphone is the global leader in advertising on podcasts. So now suddenly what's happened with that acquisition is that Spotify is enabling people like us, BizNews, who've got our podcast on the Spotify platform as well as elsewhere, but also there, to start putting advertising into our podcasts in the same way as Google has become this giant by allowing people with websites to put advertising via Google. So if there's somebody in China who likes the look of, or likes the podcast that we're producing at BizNews and wants to be identified with it, or wants to reach the market who will listen to them, they can buy those that now through Megaphone in the same way as someone in China could buy advertising on Google. I hope that all makes a lot of sense. it's the Google, Megaphone is the Google ads of the podcasting field. It's now part of Spotify. So you can see how the market reacted to that. Really, really liked it. Initially, a little bit concerned, wasn't too sure, but after they'd done their homework, well, Spotify up 19% in the past month. I haven't got a graph for you on Discovery, but the Discovery share price, as mentioned right in the introduction, and for those who've joined us a little later, reacted to the news of Hilton Kellner being made the chief executive of Discovery Bank, and on the progress report from Discovery Bank, which is showing that everything that they've been aiming towards is working in the right direction. It's a very exciting time for South Africa and for banking in South Africa. We are quite big fans of what Discovery have done internationally. And if they can take their shared value concept and apply it aggressively in the banking field, well, there's no reason why we can't see Discovery Bank being a huge, huge success. Anyway, so those are the big stories. The other big story of the past month was, before we go there, here's another reason why we love Spotify. I'll put this in because these are the top 20 podcasts on the Spotify platform on news and politics, they call it, in South Africa. As you can see, they're dominated by the international podcasts. The New York Times is the daily #1. And in fact, the top six are all international podcasts. Then comes Gareth Cliff at #7. He's done very well. He's been focusing on podcasting, in fact, for 7 years. And now he's reaping the rewards there. The next local podcast is coming in at #11. That's Bruce Whitfield's Money Show with the power of 702 and Cape Talk behind it. And look who's at #13. We've actually got to #10 before, but BizNews Radio at #13. So thank you very, very much for your support, and be assured that we're continuing to invest our time and energy in becoming one of the leading podcast producers in the country. It's a lot of my attention, a lot of my work today is invested in podcasts, and it's lovely to see that our company, our bet that we've made on podcasting is paying off quite well. You have to go down a long, long way to find any of the, if you like, traditional media players in South Africa making any kind of an impact there. Clement Macantela's show coming in the top 20 as well. But it's interesting to see this, that literally you have 4 South African podcasts or South African produced podcasts, the top 20 in this country. And you can then appreciate how these are growing and growing so rapidly. Okay, the other big story is the Rand. And here you can see the performance of the Rand in the past month. Once again, we came from around 15.30 to 15 on the dot this morning against the US dollar. And a few people are now starting to predict that the Rand is going to go stronger for longer and so on. The reality is it's just back in its channel. And if you have a look at that channel, the first spike was Nenegate, when the Rand was weakening over a lengthy period, and then it took an awful hammering, if you recall what happened in Nenegate, but then retraced its footsteps when Pravin Gordhan was appointed. That was on the 13th of December 2015 as the Minister of Finance. It showed that the lunatics might be running part of the asylum, but they hadn't got their hands on the Treasury. And then the Rand went back into its usual softer or declining trend, with a blip taking it to better than 12 on the Ramaphosa issue when Cyril Ramaphosa was elected president against most expectations. In fact, at the time, pretty much all of the media around the world were quoting experts saying that Mrs. Zuma would be elected, but that last-minute switch by Didi Mabuza changed all of that, of course. And then you can see the other blow-off, which is very similar to what happened at Nenegate more recently this year, and that was due to COVID-19 and the panic, which suggested that countries like South Africa were going to be the worst affected. Well, we all have our views because COVID is such a big part of our life right now, but the international markets views are that South Africa will be no worse off than any other country, really. And as you've seen, the Rand has then retraced in the same way as it retraced after Nenegate, and it's now back in that channel. So if you were among those who were thinking that perhaps the Rand's recent improvement is the start of a new trend, I would caution you against that, because it really is, when seen in this 7-year perspective. And by the way, it's quite nice, because if you go back around 6 years, we were at 1127 when this portfolio began. So part of the whole idea of the BizNews Global Portfolio, as it was originally, was that we could benefit as the Rand weakened and continues to weaken in the long term. For the moment, it seems about in the middle of that channel. So you could probably expect it to be bouncing somewhere between 14 and 15 or 15 and a half over the next little while, until we get our next, who knows what's going to hit us next. But we could have a Ramaphoria type surge or improvement in the value, or a pandemic or Nenegate kind of blow off. But expect this, because the Rand represents a country which is only 0.5% of GDP, and in the past couple of months, we've seen a lot of strength coming through as reality again prevailed about the way that various countries around the world, including ours, have handled the pandemic. And there's the portfolio. To put it in perspective, when the pandemic hit, when there was panic in March, the portfolio was worth 6.8 million. Interestingly enough, remember, we started that at 2.2 million. So even with the biggest of the sell-offs, it showed that being correctly invested in exponential companies was a very, very good defense against whatever was thrown at you. But subsequent to March 2020, the portfolio constituents have done very well. We've also had some incredible returns through the purchases that we made. You might recall that we decided to sell out of Berkshire Hathaway, and we sold out of the we had the mid-cap index on the JSE. I think it's the Ashburton mid-cap 30, I think it's called, and then invested directly into some of the stocks that we really liked at the time. And the 2020 purchases include Sasol, which we bought at 28 Rand and then sold at 145 Rand. So those are reflections of some very good fortune, or a lot of good fortune in the stock picking. Discovery up 150% from where we bought it. That's in US dollar terms, because the Rand has appreciated, but it's more than doubled in Rand terms. And Cloudflare being the star performer of those that we purchased. But of course, neither of them look even vaguely close to the returns that we made on Sasol by buying them at 28 Rand a share. But there's the portfolio generally. The best performer by far is Amazon, our 10-bagger in Rand terms, but very strong performances as well, pretty much across the board. Naspers has done fine. It's been with us since September 2019. We did consider, you might recall, lightening or selling out of Naspers, but then after a decision, we decided not to do that, because it is trading at such a huge discount to its underlying value. And thankfully, Naspers has come to the party. They, if you were on the Rational Radio webinar a few weeks ago with Basil Skodos, the Chief Financial Officer of Naspers, you would have heard that the $5 billion share buyback is only one of an armory of potential issues that Naspers executives are looking at to close that 50% discount between the current share price and the value of Naspers' holding in Tencent alone. Outside of that, the rest of the portfolio is worth another $30 billion US, according to Basil, and he was quoting analysts. So if you look at it properly, if you take it to its logical conclusion, then the real discount on Tencent is sitting at more like 60 to 70% rather than the 50% where it is. Now you really are, you're buying a dollar's worth of asset there for 40 cents, and you just can't sell a stock like that. So that's our story. It's been a good month as well for 2U. I didn't mention that in much detail, but that's one of our sleepers. It is the global leader in online tertiary education. It's been a huge beneficiary of the lockdowns and remote learning that we've seen. And although the share price is doing slightly worse, or is slightly cheaper than the time that we bought in, this is one of those that you put into the portfolio and don't worry about it. I've got a record of doing that, by the way. It's very, very rare that you'll see that stocks that are added to this portfolio suddenly react in a positive manner. They usually take a few months before they move in the right direction. So it's just all about patience. And the other story there is a slight decline in Wilson Bailey. I'm not at all worried about that. There are negotiations going on with a potential Chinese buyer. And I see I got the color wrong there for the US dollar, right? That should also be green, by the way. But in rands, we're down 8% at the moment in rand terms, from 110 rand a share to 101.5. But if you haven't bought into Wilson Bailey, there's no reason to be afraid of doing so. It's got two real benefits. On the one hand, there is a Chinese buyer who's sniffing around, and they primarily like the Australian asset, but they also like, which by the way, this Australian asset makes more than half of Wilson Bailey's sales now, but they also like the South African asset on the view that the infrastructure program here is going to go forward. So that's the story of the portfolio as a whole. And just to give you that feedback, or the summary again, in the past month, up 7.5% in US dollar terms, up 5% in rand, and going back 6 years, because this is the 6th anniversary of where we started. We started with 2.25 million rand roughly, and you can see now it's worth 10.5 million rand. And from US dollars, we started with 200,000 US dollars, because that was the whole intention, was to do a US dollar portfolio, and that's now worth $700,000. And when you have a look below that at the compound annual growth rate, it gives you an understanding of what Warren Buffett calls the eighth wonder of the world, which is compound interest, or in other words, growth on growth. Okay, Stu, before we go into the individual performances, have we got any questions?
Yes, thanks, Alec. I've got some good questions to come through. You're mentioning Hilton and Discovery. Young Engelbrecht wants to know, I would like to know whether we can expect Discovery to become the next Capitec, and that we therefore should hold on or increase our Discovery share investment.
Yeah, I'm a huge fan of Discovery. To be the next Capitec in the banking field is unlikely, given that Capitec is a transaction-driven bank at the bottom end of the market. But it could well be that they scoop away a lot of market share higher up the ladder. They are attacking RMB to a large degree, and Investec. Those are the two banks that have the most to fear from Discovery. Where Discovery's advantage comes in, and we're just talking banking for the moment, is that they do have this shared value concept. And I'm a Discovery client. I must tell you, only recently did we put our motor vehicles through Discovery Insure. And this month, I got back on, I haven't been spending much on petrol. I think it was 800 Rand. I got back 120 bucks from my petrol account, because I hadn't ridden, I'd been driving sensibly. I hadn't been braking too badly, and they tell you all of these things. It's phenomenal. If you understand, or if you can measure what it is, and if you get an instant reward in that way, then this month, I'm going to be even more cautious in my driving, and perhaps get back more than 120 bucks out of the 800 Rand that I spent on petrol. It's a fantastic concept. anybody who's a Discovery client and has used and got into, if you get into the ecosystem, you'll see the benefits that exist there. So perhaps, Jan, you're onto something. Perhaps where Capitec has been phenomenally successful is that it's brought in very, very low-cost banking and massively disrupted the status quo on that side. What Discovery is doing at a much higher level is it's also heavily disrupting that part of financial services. But for me, the real excitement about Discovery is the offshore arm of it. I've seen during our 3 years in London, the health minister of the UK, or the equivalent, I think they called the health secretary, Matt Hancock, at a Discovery function, praising Discovery for the incredible innovation that they've done. I've seen at one of the functions that I went to, one of the top guys at Apple, number 3 or 4 at Apple, praising Discovery and the partnership that they have with them. Now, there are very, very few South African companies that would even be mentioned in that kind of elite atmosphere. So this is a world-class business. It's a world-class operation. And I'm very, very excited about Discovery's opportunity globally rather than just South Africa. But on the South African side, the banking opportunity is big. Really, at these kind of share prices, it's the kind of stock that you put in your portfolio and you don't worry about, and then you find suddenly a month like we've just had where the share price is up 16%. So I would be supportive of a decision to increase your shareholding there, or to buy some if you don't have any yet.
Thanks, Alec. This is a question from Julian on the valuations. He says, I see yet another article from the Wall Street Journal talking of unwarranted high-tech valuations. Doesn't it sound more like a bubble, and won't a fall impact the FANG stocks as well?
Yeah, it's and I've been publishing those, and I hope you're all reading the Rational Perspective newsletter. I spend quite a lot of time. It's only for premium subscribers, and what happens on that, apart from the little commentary that I write in the beginning, I also have a look at the Wall Street Journal and try and find the most relevant and suitable articles that I can share with you on a daily basis. And you will have noticed recently that there have been quite a few articles that have been talking about the IPO hype. Now, there's no doubt that the new listings boom in the United States is the most spectacular since what happened in the .com era. And I've got personal experience of that. Those of you who've watched my career will remember that I listed MoneyWeb in 1999, in July 99, at a forward price to earnings ratio, projected price to earnings ratio, that is, of over 100. And I can assure you that if we'd had 5 times as many shares that we wanted to issue than the 10 million rands that we did, we would have placed that very easily. We were inundated with professional investors, unit trusts, asset managers, just wanting our stock. Of course, a couple of years later, after the .com bubble had burst, the shares that were placed at a rand were sitting at 18 cents, and then nobody wanted them. But it just is the way of the market. Would we see a repeat of this in the United States? Possibly. But what we do know is that with hindsight, the .com bubble was fully justified. With hindsight, I say this, because you have a look at a share price like Amazon, which fell 95 or 96% from its peak in the burst. But had you gone back and just bought it at its peak, today you would have been showing a huge return on your investment. The problem that one has with IPOs or with new listings is you need to pick the winners. So if you can pick the winners today, then the prices that you're paying today, no matter what happens with the volatility over the next few years, and there's got to be volatility with the way that valuations are being knocked about by Mr. Market, as long as you can invest in the winners, there's no reason to fear a pullback. And what we've tried to do in this portfolio from the beginning, and what I'm hoping that we can achieve, is by being sensible and disciplined in our purchases, in purchasing only those companies that we can see good long-term futures for, or those companies that already have a dominant position in a market that is expanding rapidly, and then to grow with the exponentiality that they are enjoying. So to just look at the whole market and say the market's overpriced, I think is a little bit like when I was a young reporter in South Africa, people used to talk about the market, the JSE. Yet there were two very distinct parts to that Johannesburg Stock Exchange index. The one being the mining index, which is about 60% of the total index, and the other being financial and industrials, which was the other 40%. And at times, the mining industry would be absolutely booming and would then pull the index up, but the industrials and financials would be almost collapsing. And you'd have vice versa as well. When the mining sector went into a recession for global reasons, and then financials and industrials might have been improving for whatever reason. So it's to me, it is very dangerous when everything is painted with the same brush. And it's the same thing that we're looking at right now. On the IPOs that have come through, are some of them out of whack, like Airbnb? It looks it to me, but I don't really understand their numbers well enough to be able to first of all buy or even go short on them. It's a little bit like Uber. When Uber came to the market, there was an enormous amount of hype, and we know that it's come under a lot of pressure subsequent to that. So much better to buy into a company that you understand. And these companies that are in the portfolio, I do understand them. I've done my homework, and I suggest that you do the same. Either use the products or get to understand it better. You know, before this, for a few days now, I've been really looking at what we're going to replace the sale of Slack with in this portfolio. On the local front, I really like Tongaat. I can't believe that you've got a share price that was once 30 times where it is at the moment, and that the shares with an excellent management team have not appreciated more rapidly, given the way that this is being turned around from an exaggerated negative position, I'm sure. Because if you're the management team, you're going to go and do a turnaround. You're not going to make things look good. You're going to make things look real bad. But I don't quite understand the business, or understand the business sufficiently to be able to say, whammo, let's go in there. It just takes a lot of work. A similar situation was another stock I've been looking at very closely and absolutely love is Xero, which is an Australian listed accounting software company. Unfortunately, the share price is, it's a little bit like Cloudflare. It's such a good business that every time you look at it, it looks hugely expensive. But there will come a time that that stock will be the kind of thing that with some confidence you can add to the portfolio. So I hope I'm giving you a sense now of why you shouldn't be put off by the headlines, or why you shouldn't be sucked in by the hype, but rather try to do your own work, try to do your own understanding. And if you understand the company and what the company's about and what the company's doing, which in every single instance in this portfolio, I feel confident enough that I do, then you should be able to buy those shares with confidence, knowing that as an exponentially growing company, it is going to have its bumps in the road, but those bumps might be an opportunity for you to buy more of the shares, or alternatively, if you know exactly why you bought them in the first place, and the price that you paid in the first place was according to the calculations you've already done, then just go for the ride. Continue with the ride. But first and foremost, know the business well enough. Understand it. Know exactly what it is that you're buying. And as a result of that, you become a co-owner in the company, And the most important thing is you, as a co-owner, you can see when things are going wrong. And that's the time to leave, not when the share price falls.
Excellent, thanks, Alec. There's a nice comment here from Paul. He says, to Alex Stewart and all at BizNews, it can be directly attributed to my subscription with BizNews and more accurately to the BizNews Share portfolio that my family and the staff of my small tourism business have weathered 2020 relatively unscathed. I wish you, your staff, and your family a blessed Christmas and continued success in the new year. Off the back of that, He does say, are you looking at EOH at all with its new leadership as well? So just a question on the back end of that. But very nice comment from Paul. Thanks very much.
Well, Paul, we feel for you. The whole COVID, in fact, we were talking about it this morning. There cannot be any industry that is as directly affected by this and your day-to-day operations than tourism. I can just imagine now that that my pal has actually been positive COVID, and I'll be isolating for at least the next 5 days. What happens if I was in your business, if I was a tour bus operator or a tour guide? That's just wiped out. And who knows how often you're going to come into contact with people who are then subsequently positive to COVID. And if that's the case in your business, you just can't work. In our business, we can. Here we are. We can't really call it work, but anyway, we are serving our community right now. So just thinking about that, Paul, I'm very pleased that we were able to play a small role in your ability to weather this incredible storm that for certain sectors has been is historic. And I'm sure, like most things, once you come through it, once we get through this, in those areas that have gone through the worst of the fire, you're just going to be so much stronger. EOH is a very, very, very good one to look at. A very good one to look at. I know Stephen Collar quite well. In fact, Stephen Collar, the chief executive, is the reason why this portfolio exists in the form that it is. And I say that with no hesitation because in 2014, just after BizNews had started, 2013, he brought out the Singularity University faculty to South Africa, and he was then the CEO of Absa Capital, and he exposed them to the clients of Absa Capital, who I truly hope listened as closely as I did at the time. Okay, I've got an advantage because this is the field that I'm in. I've been in digital field since the late 90s. But that faculty that came out, Peter Diamandis, and the whole crew that was with him, explained or got it through my thick head how exponentiality works. And by understanding that, and he said, exponentiality is something very difficult to get your head around. But once you get your head around it, you have a much better way of understanding how these seismic changes that we're seeing in the world will impact the capital markets and the investment markets. So if Steve hadn't brought the Singularity guys out to South Africa and made us our little BizNews, as we were at the time, the media partner for that, who knows? I'd probably still be scratching my head and buying value stocks or some momentum stocks. But going to the next level, to the exponentiality level, was a direct consequence of that. So having said that, he's a smart guy. He understands exponentiality. He is a man with great integrity. He's got really good shareholders who happen to also be our business partners here, the Leboucher guys. And they will support him to take EOH to its logical conclusion. I think you're onto something there. I haven't analyzed the company properly. I need to be doing that. But if EOH can get back the Microsoft licenses that it lost because of the corruption that occurred there, you have to believe that that would be giving it a huge boost. And with the kind of people who are now behind the company, that surely has to be on the cards at some time in future. So it's a good business. I suppose the question is, and a little bit like Tongaat as well, as you are fixing it and having to sell off businesses to stabilize the ship, are you losing too much of your future growth potential? I think with a guy like Steve, he's too smart to make that mistake, as is Gavin Hudson at Tongaat Hewlett. So it's, to me, it's in the same boat. It's almost like David Shapiro's got his what does he call it, his bankrupt portfolio or something, where he took a whole list of shares, 15, 20 shares that had been really smashed during the COVID panic, and he said these are stocks to buy into and wait for normality to return. To me, my graveyard shift would be EOH and Tongaat. And who knows, maybe after I've done some more work on EOH, we might bring it into the portfolio next month.
Excellent, thanks, Alec. Yeah, it's his takeover portfolio that he put together. I think out of the 12 stocks, only one is in the negative, and that's City Lodge, which is quite interesting to note. But nice to watch those little gimmicks and stuff. Alec, so what would a portfolio discussion be without Elon Musk? So Peter wants to know, he continues to puzzle the world. Would you not consider getting into Tesla again?
Sure, Peter, we had it. As you well know, we sold it. I continue to trumpet our failures, and I keep looking at it. I've got it on my watch list every day. I see it's back above goes to $650 and back to $600. It's not a stock that I know. No, let's put it differently. At the current price, I'm really waiting for something to happen, for the share price to come down a lot, and then to buy. So it's a little bit like what I said earlier with Zero. And for a while, I watched Twitter. I'm a bit worried about Twitter now, because the whole way that the world or the American authorities are going against social media companies, and they've started with Facebook. They've attacked them. You recall we sold Facebook. I'm still happy we aren't there. We sold Google. I'm still happy we aren't there as well. They are in full frontal attack from the antitrust authorities. Twitter is going to get pulled into that, is undoubtedly, because on the micro messaging, it is dominant in its field. I wouldn't be buying Twitter if it came back a lot, but I would certainly be buying Zero and certainly buying Tesla if we saw the share price retracing significantly because of one or other global event or big event. So buying it now at $600, maybe I'll kick myself in a year's time again. But for the moment, I'm watching. You know, they've put together 5 quarters of profit, and there were analysts who said they'd never make a profit. So the other thing that I love about Elon is he's gone out and he's raised $5 billion. So another $5 billion. He's got $20 billion that he's raised. So whatever happens to Tesla for the next 10 years, he's got enough money to keep it going, to keep things ticking over. So he'll be around when many of his competitors won't be. But at $600 a share, sure, you know, you've got to be brave to be buying it there. I'm much happier to be buying it at maybe $400 or $300 a share. But even that is, is 5 times more than what we sold at. So unfortunately, thankfully, we didn't sell Amazon. Unfortunately, we did sell Tesla.
Thanks, Alec. Jack just wants to know he wants to know your view on the pharma shares, and that'd be Pfizer and AstraZeneca. I don't know if you have any comment.
I just don't know them well enough. I do like Aspen, and it's been a good performer. The reason I like Aspen is I like the story that we were told by Stephen Sard when he was on our webinar. He spent an hour with us and handled all our questions really well. He's refocused that company, restructured it. It now is at a very, very reasonable price relative to past years. The management have sorted it out. It's not demanding on any of the financial matrices you want to look at, and I understand it better because it's here at home. Also, they've reconverted their Port Elizabeth plant into a vaccine making plant, and Aspen is now being much, much more appreciated by its past opponents in government who who now realize how important it is to have a health champion. I think there'll be a bit of a rubble for discovery on that as well, but and maybe even for the hospital shares, but definitely Aspen will be a beneficiary of that. When you start talking about AstraZeneca and Pfizer and those big companies who are playing in the big global markets, I just don't know them well enough, and I'm reminded of the disaster called Bayer after they bought Monsanto, you might recall, and Roundup, just one product in the portfolio, has smashed the Bayer share price. So I'm very cautious of buying or investing in something I don't understand, and I don't understand it. But that doesn't mean that if you're in the pharmaceutical industry and you've got a good feel of it, and you believe that these are well-run, good, strong companies, that you should take any notice of what I've just said. Often what we should do is have a look within our own business, within our own area of competence, our own circle of competence. And they're pretty small relative to the world as a whole. But within our circle of competence, we tend to understand a bit better who the good and the bad are. What Buffett, as a young man, Warren Buffett, as a young man used to do, was he would go and interview chief executives of companies in sectors that he was interested in. And his question to them always was, excepting for your company, what are the 3 other companies that you would invest in for the next 5 years if you knew the stock markets would be closed in your sector? And then he would ask them, which are the 3 companies you would definitely not invest in for the next 5 years? And that way he would get an insight from the people who really know, not just the competitors, but it could be, he used to talk a lot to chambers of commerce, the executive directors of chambers of commerce, and get useful insights there, or from suppliers, and get that as well. Now, if you're in an industry, you will know far better than some theoretical guy who's sitting there just looking at balance sheets, because what Phil Fisher, and remember Buffett is 85% Benjamin Graham, 15% Phil Fisher. What Phil Fisher wrote about was a thing called scuttlebutt. And the scuttlebutt is that understanding, what people are saying about others in the industry, what they're up to, which companies would you want to work for, which wouldn't you want to work for, and so on. So if you're in pharmaceutical industry and you know those companies well, don't hold back. However, if you don't know them well and you're not in the industry, then it's best to be more cautious. There are thousands and thousands and thousands of investment opportunities, including in yourself, and you can go off and buy yourself a course to learn something. So why risk your money with somebody else if you're not completely sure of what you're buying?
Thanks, Alex. It's an interesting question from Derrick. He says, besides any of the new shares you mentioned or you have in mind, are you thinking of adding on a regular or ad hoc basis to any of the other shares that you already have in the portfolio?
Yeah, it's a very, very good question, because it is something that we now in this portfolio, we're at a, well, you can see we've got it's more than a dozen shares that we are holding. So to add a new stock to this portfolio, when you've got a fairly good shareholding already, and it's every new share that you own means you've got to learn more about it. I suppose we're getting to the point now where whatever we do from here, we're going to have to either lighten our existing holding or sell out in total from one of our existing holdings, or maybe, and that's if we do find something else that is worth putting in there. The only share, and you have a look at that individual stock performance, is the only shares in plural that at the moment could be worth not investing more into would be WBHO and Naspers, on the basis that WBHO is there because of it's a bit high risk. There is a Chinese suitor, and there's also South Africa's infrastructure program, which may or may not be affordable. and may or may not go partly to WBHO. So that's the one. And Naspers, for a stock to be trading at such a huge discount to Tencent, is telling us something. We saw today that the Chinese government has fined Tencent and Alibaba, not a huge amount of money, but it's almost showing its muscle, as it did with Alipay, with aborting the listing of Alipay, which is a major part of Alibaba, just 2 days before Alipay would be the biggest IPO in history. And I'm very nervous of authoritarian governments when you're investing in companies that are completely exposed to them, as Tencent is, and by definition, Naspers. So maybe that 50-60% discount is justifiable. I don't know. But as for the rest of them, every single stock there, I'd be quite happy to be putting more money into it.
Thanks, Alec. I always love this webinar because I always have to check the clock because the time flies, and it seems we've just run over 1 o'clock. So I think we should unfortunately call it an end to our last one of the year, Alec.
Indeed, and there's the portfolio after the Slack sale. So we haven't added anything yet. A nice idea, though, to spread that R500,000 amongst the shares that we have there. I'm really keen, though, on maybe those two that we did mention, if they come through the research process properly, Tongaat and EOH, as nice turnaround stories. You know, if you have a look there and you see Cloudflare, which is was only 3% of the portfolio, you might recall we only put 1% into it because I was so concerned at the high valuation at $25 a share, and it's now at $80 a share, and it's only been 9 months later. So sometimes you can be a little bit cautious when you don't really need to be. But when you have a portfolio that is done as well as this one and has got the scale of this one now, then those kind of opportunities can be considered. So generally speaking, are we likely to put that 575,000 Rand back into every and spread them amongst the stocks that we have at the moment? Probably not, because part of the investment game is to get excited by the opportunities. But I'll do my homework over the Christmas period, and maybe you can as well. Have a look at EOH, have a look at Tongaat and the local scene, and then internationally, have a look at Zero and ASML, which is a stock that David Shapiro has told us about from the Netherlands, which is very, very exciting too. So the beauty about all of this is that nobody forces you to buy, and when you put your money down, it's on the basis of what you understand and what you take responsibility for. And that really has been the intention of the BizNews Share portfolio, which is now celebrating 6 years. And thank you again for being with us for this journey. It's been so exciting. I've learned so much by having to serve you every month and account for what we've done in this portfolio over that period of time. And I wish you and your loved ones all the very, very best over this festive season, and look forward to being back in your company again, same time next year. Until then, cheerio. And just to remind you that there will be a recording of this webinar on the BizNews channel on YouTube. Just look out for it later this afternoon and put into Google BizNews YouTube. Up she'll pop, and it'll be there for you to look at your leisure. Until the next time, cheerio.